There is a retirement withdrawal strategy that allows you to access your retirement savings years, or even decades, before you turn 59 and a half with zero early withdrawal penalties and with zero income tax on the money you pull out. It is completely legal. It is written into the IRS tax code, and the vast majority of Americans who could benefit from it have never heard of it. It is called the Roth IRA conversion ladder. And if you are someone who wants to retire early, or who simply wants more flexibility and control over your money before traditional retirement age, understanding this strategy could be the most valuable financial information you encounter this year. My name is Jack Sterling, and today I am going to walk you through exactly how the Roth conversion ladder works, the specific mechanics behind why it is legal, the year-by-year timeline you need to follow, and the exact steps to start building your own ladder right now. Before we go any further, everything in this video is for educational and informational purposes only. It is not financial advice, tax advice, or investment advice of any kind. I am not a licensed financial advisor or CPA. Tax laws change, income thresholds adjust, and your individual retirement situation is unique to you. Please consult a qualified financial professional or tax advisor before implementing any retirement strategy. With that understood, let us get into this. To understand why the Roth conversion ladder is so powerful, you first need to understand the problem it solves, which is what most financial educators call the 59 and a half wall. Here is the core issue. Most Americans build their retirement savings in tax-deferred accounts, specifically 401k plans and traditional IRAs. These accounts come with a significant tax benefit. The money you contribute reduces your taxable income in the year you contribute. But in exchange for that tax benefit, the IRS imposes a rule. You generally cannot withdraw that money before age 59 and a half without paying both income taxes on the withdrawal and a 10% early withdrawal penalty on top of that. That 10% penalty is not a small number. If you have saved $200,000 in a traditional 401k and you need to access it at age 45, you would owe ordinary income tax on the full $200,000 withdrawal, potentially 22% or higher, plus the 10% penalty on top. You could lose 30% or more of your retirement savings to taxes and penalties in a single withdrawal. This creates what many early retirement advocates call the retirement account trap. You did everything right. You saved aggressively, you maxed out your accounts, you got the tax deduction. But now the money is locked away until you are nearly 60, and accessing it early costs you enormously. But here is the critical distinction most people do not know. A Roth IRA is fundamentally different from a traditional IRA or a 401k in how it handles withdrawals. With a Roth IRA, contributions are made with after-tax dollars, meaning you do not get a deduction when you contribute. But in return, qualified withdrawals in retirement are entirely tax-free. And more importantly for our purposes today, your original contributions to a Roth IRA can be withdrawn at any time, at any age, with no taxes and no penalties. That last point is the foundation of the entire conversion ladder strategy, and understanding it changes everything about how early retirement can work. Now let us get into exactly how the conversion ladder works, because the mechanism has a few moving parts, and understanding each one clearly is what makes the strategy executable rather than just theoretical. The strategy starts with a traditional IRA or a 401k, a tax-deferred retirement account that you have been contributing to. The goal is to gradually move money from that traditional account into a Roth IRA through a process called a Roth conversion. A Roth conversion is simply taking money out of a traditional IRA or 401k and moving it into a Roth IRA. Now, when you do a Roth conversion, you owe income tax on the amount you convert in the year of the conversion. That is unavoidable. If you convert $40,000 from a traditional IRA to a Roth IRA, that $40,000 is added to your taxable income for that year. But here is where the strategy becomes powerful. Under IRS rules, converted Roth IRA funds, meaning money that was converted from a traditional account, not original contributions, must wait 5 years before they can be withdrawn penalty-free. This is called the Roth conversion 5-year rule. After 5 years from the conversion date, that converted money becomes accessible with no penalties, regardless of your age. So the ladder works like this. You make a conversion in year 1. 5 years later, the money from that conversion is accessible penalty-free. You make another conversion in year 2. 5 years after that, year 7, the year 2 conversion becomes accessible, and so on. You are essentially building a ladder of conversions, each rung a different year's conversion, that unlocks 1 year at a time, 5 years after each one is made. The ladder gives you a perpetual stream of penalty-free accessible funds as long as you started building it far enough in advance. The ideal scenario for this strategy is someone who retires early, say at age 45 or 50, with significant tax-deferred savings, and who wants to access their money before 59 and a half without penalties. If they start the conversion ladder 5 years before they plan to retire, or 5 years before they need the money, the first rung of the ladder is ready exactly when they need it. But here is what nobody is telling you. The conversion ladder is not just for the FIRE crowd or for people who plan to retire at 40. It is a flexible tax management tool that can benefit anyone who expects to be in a lower tax bracket in a given year and wants to strategically move money out of a tax-deferred account at the lowest possible cost. I am going to show you the year-by-year numbers right now so you can see exactly how this plays out in practice. And if this kind of strategy-level financial content is useful to you, subscribe right now. We release new financial investigations 3 times every week, all free, all built to give you the specific mechanics behind how the financial system actually works. Let me walk you through a concrete year-by-year example so the ladder is completely clear. For this example, let us say someone is 40 years old. They have $400,000 saved in a traditional IRA. They plan to retire at age 45. Their goal is to access that money after they retire without paying the 10% early withdrawal penalty and without generating large taxable events in retirement. Starting 5 years before they plan to retire, at age 40, they begin the conversion ladder. Year 1, age 40. They convert $40,000 from their traditional IRA into a Roth IRA. They owe income tax on that $40,000 this year. If their effective tax rate while still working is 22%, they pay $8,800 in tax on the conversion. The clock starts on the 5-year rule for this rung of the ladder. Year 2, age 41. They convert another $40,000, another $8,800 in tax paid. Second rung of the ladder started. Year 3, age 42. Another $40,000 converted. Third rung started. Year 4, age 43. Another $40,000 converted. Fourth rung started. Year 5, age 44. Final pre-retirement conversion. Another $40,000. Fifth rung started. Age 45, retirement. They stop working. Their income drops dramatically. Now they are living on savings and possibly some other low-income sources. Age 45, year 6 from when they started. The year 1 conversion has now completed its 5-year waiting period. The $40,000 converted in year 1, plus any growth on that amount that remains inside the Roth, is now accessible completely penalty-free as a return of converted principal. They withdraw that $40,000 to live on, 0 penalty. And because it is a return of converted principal, not earnings, it is also not taxed again, since they already paid tax on it in year 1 when they converted. Age 46. The year 2 conversion unlocks. another $40,000 available. Same story. No penalty, no additional tax. Age 47. Year 3 unlocks. Age 48. Year 4 unlocks. Age 49. Year 5 unlocks. And by the time they reach age 50, they have had 5 years of penalty-free, tax-efficient withdrawals, all from money that started in a traditional IRA, funded entirely by a ladder they built before they retired. At age 50, they are less than 10 years from the traditional 59.5 threshold, and they can begin adding new rungs to the ladder from any remaining traditional IRA balance to continue the bridge. The total tax paid on conversions over 5 years in this example, approximately $44,000, assuming a consistent 22% rate, funded 5 years of retirement income. Compare that to what they would have paid if they had simply withdrawn from the traditional IRA early. That same $200,000 would have generated approximately $44,000 in income tax, plus an additional $20,000 in early withdrawal penalties. The latter saved approximately $20,000 in penalties alone, and potentially much more in income tax if retirement income is in a lower bracket. Now let us talk about who the Roth conversion ladder works best for. Because I want to be honest that this strategy is not optimal for everyone. Understanding where it fits and where it does not is what makes the difference between using it wisely and creating unnecessary tax complications. The conversion ladder works best for people in 3 specific situations. The first situation is someone pursuing early retirement who has significant traditional IRA or 401k savings and a 5-year window before they plan to stop working or stop needing traditional income. The earlier you start building the ladder, the more flexibility you create. If you are 38 and planning to retire at 45, you have 7 years to build a robust ladder. The second situation is someone in a transitional low-income year. Perhaps they left a high-paying job, started a business, took a sabbatical, or moved to part-time work. In a year when your income is significantly lower, your marginal tax rate on additional income is lower. That means the tax cost of converting traditional IRA funds to Roth is lower. Converting $40,000 in a year when you are in the 12% bracket costs $4,800 in tax. Converting that same $40,000 in a year when you are in the 24% bracket costs $9,600. The latter is most tax efficient when built during low-income years. The third situation is someone doing long-term tax diversification, building a mix of tax-deferred and tax-free retirement assets so that in retirement they have flexibility to draw from different account types depending on the tax environment at that time. This is sometimes called tax location strategy, and the Roth conversion ladder is one of the tools used to implement it. There are also situations where the conversion ladder is less ideal. If you are in a high-income year, converting large amounts will push you into higher tax brackets and reduce the efficiency of the strategy. If you have no other liquid savings to live on during the 5-year waiting period between conversion and access, you would need to fund your lifestyle some other way while the ladder matures. And if you are already past age 59.5, the penalty concern disappears and a simpler withdrawal strategy may make more sense. The most important variable in this strategy is your effective tax rate in the year you convert versus your expected tax rate in retirement. The larger that gap, especially if you expect to be in a significantly lower bracket in retirement, the more powerful the conversion ladder becomes. Stay with me, because this next section is critical. I am going to walk you through exactly who this strategy works best for, and just as importantly, who it does not work for. Because using this incorrectly can actually create a larger tax bill than doing nothing at all. I am going to make sure that does not happen to you. Here is your complete action plan. 6 steps, all specific, all executable starting this year. Step 1. Audit your existing retirement accounts. Log into every retirement account you have, 401k through your current or former employers, traditional IRAs, SEP IRAs, simple IRAs. Write down the total balance in each account, what type of account it is, and whether the contributions were made pre-tax or after tax. This is your raw material for the conversion ladder. Step 2. Open a Roth IRA if you do not already have one. Roth IRAs are available at most major brokerage firms. Fidelity, Vanguard, Schwab, and Charles Schwab all offer them with no account minimums and no annual fees on basic index fund investing. Opening an account takes approximately 10 minutes online. If you already have a traditional IRA at one of these institutions, opening a Roth IRA at the same institution simplifies the conversion process. Step 3. Determine how much to convert this year. The optimal conversion amount is the amount that fills your current tax bracket without pushing you into the next one. If your taxable income this year puts you in the 12% bracket and the top of the 12% bracket is $47,150 for a single filer in 2025, you can potentially convert up to that limit at the 12% rate. A tax professional can run this calculation precisely for your situation. Step 4. Execute the conversion. At Fidelity, Vanguard, or Schwab, you can initiate a Roth conversion directly through your online account. The process involves selecting the traditional IRA account, choosing the amount to convert, and directing it to your Roth IRA at the same institution. The custodian will generate a Form 1099-R, which you will use when filing your taxes. You will report the conversion on Form 8606 of your tax return. Step 5. Set a calendar reminder for 5 years from the conversion date. This is the date the converted funds unlock, when they become penalty-free accessible as a return of converted principal. Label it clearly. Roth Ladder Year 1 unlocks. Repeat this for each annual conversion you make. Step 6. Build a 5-year liquid bridge. The Roth conversion ladder requires a 5-year waiting period between conversion and access. During those 5 years, you need another source of funds to live on, whether that is taxable brokerage accounts, savings, dividend income, part-time work, or original Roth IRA contributions that can always be withdrawn penalty-free. Planning the bridge is what makes the ladder executable in practice, not just in theory. For free tools to model your conversion, the IRS provides Publication 590-A and 590-B, which cover Roth IRA rules in full. The website Roth Conversion Calculator at smartasset.com and the retirement calculators at dinkytown.net allow you to model different conversion scenarios with different income assumptions. Before we close, one final reminder that everything in this video is for educational purposes only. The Roth conversion ladder involves real tax events. You will owe income tax in the year of each conversion. The 5-year rule has nuances that depend on your age, your account history, and the type of conversion. This strategy has significant value when implemented correctly and can cause unnecessary tax costs when implemented without proper planning. Please work with a qualified CPA or financial advisor who specializes in retirement planning before executing any conversions. But here's what I want you to take from this video. The 59.5 wall is real, but it is not the only option. The Roth conversion ladder is a documented IRS-sanctioned strategy that has helped thousands of early retirees access their savings years before the traditional window. It requires patience, 5 years of planning. It requires tax awareness, knowing when to convert and how much. And it requires a bridge, a way to fund your life while the ladder matures. All of those things are learnable. All of them are actionable. And you now understand the core mechanics better than most people who will retire without ever knowing this strategy exists. If this opened a door for you, hit subscribe. We release new financial strategy videos exactly like this 3 times every week. Free, specific, built around the mechanics that actually move the needle. And I have one question for you in the comments right now. Comment yes if you already knew about the Roth conversion ladder before watching this video. Comment no if this was new to you. I read every single comment, and I want to know how many people are already using this. I will see you in the next one.